I'm going to cover navigating debtors and creditors. I'm going to do this fairly briefly. I saw that obviously on the poll we did right at the start that confidence was a little bit higher in debtors and creditors, and also the training that I did a few years ago, I covered debtors and creditors in a little bit more detail, which was on ExpensePlus's YouTube channel. So do go there if you're wanting a bit more detail, a bit more information. But what I'm going to cover here is some key principles which I really find helpful for remembering what are we doing with debtors and creditors and how they link to income and expenditure. So let's just cover debtors first. The key thing to remember about debtors is that is essentially money which is owed into your organization, whether that be certain income or whether that's even expenditure that you've incurred which shouldn't have taken place until another year. It's really about money that's due to you. And I really find this kind of concepts of push and pull really helpful for remembering how debtors and creditors work. So let's just go through it. So prepayments is about pushing out expenditure to the next year. So a prepayment is where you might have incurred some rent or insurance maybe for the next financial year. So you've spent something in your current financial year which actually relates to the next one, and you want to push out an element of that expenditure into the right financial year that it relates to. Accrued income is pulling in income which relates to your financial year that maybe has been paid after it. A classic example that we see across most charities that have donations is that you will end up pulling in gift aid that's been paid after the year end but relates to donations which took place in the year. Now, when we talk about income as well, we want to caveat that with everything Lizzie has just shared on income recognition. So if you've got a grant that was paid after the year end, as Lizzie had outlined, and entitlement, probability, measurability had been confirmed, you pull in that money because the income recognition has been met and that is deemed to be a debtor in your accounts. So I'm hoping you'll see here the link between what Lizzie's brought of the income recognition criteria and then how the mechanics of that works when doing the adjustment in your ExpensePlus or your finance system of using debtors and creditors. And then trade debtors, which is accounts receivable, otherwise known as, which is pulling income into your year based on the invoice date of which the income is related to. Creditors is basically the complete opposite. It's money which is due out of your organization, money that you either owe or that you have been, money that is sitting in your bank account that you might have to repay that you're not entitled to. So essentially it's money that is due out of your organization. So accruals is pulling in expenditure into the year that it relates to, regardless of invoice date. So you might have an invoice which relates to the year, the next financial year, but it relates to activity that took place during your financial year. So you might need to pull that expenditure in. Deferred income is about pushing income out of your financial year that doesn't relate to it. So for example, you might have received some ticket income, like Lizzie had gone through in the example of income recognition, that doesn't relate to your financial year because the conference is taking place next year and the entitlement hasn't passed. You push that income out into the next financial year. And then trade creditors is accounts payable is pulling expenditure into the year, which is based on invoice date.